Understand the cost of pulling money out of your investment accounts to purchase an asset. This is a dynamic concept a lot of people do not understand. Get ready. I want you to understand why. Whenever I acquire assets, I usually do not pay cash for those. There are 4 big reasons why I don't do this. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for 5 decades, helping people in America optimize their assets, minimize taxes, and empower their authentic wealth. In doing so, many times I teach people how to become their own banker. To make money and utilize the 3 miracles of wealth accumulation: compound interest, tax-free accumulation, and safe positive leverage. That third one, safe positive leverage, is what a lot of Americans sometimes have a hard time getting their arms around, their brain around it. It's the ability to own and control assets with very little or none of your money tied up or at risk in that asset. So this is one of the reasons why I teach a lot of people how money works and the actual cost. We call this opportunity cost. If you are pulling money out of your investment accounts in order to purchase an asset, whether it's an appreciating asset like a home or a depreciating asset like a car. I don't do it. Why? Well, there's 4 big reasons, and I'll go through these in order. The first reason is to maintain liquidity. I have learned this lesson the hard way. When you have an asset that you have paid off, you own it outright, and all of a sudden you get into trouble that could be caused by a cash flow crunch. Maybe you get disabled, unemployed, whatever. And so these things that happen, recessions, pandemics, when you don't have the money and it's tied up in these paid off assets, there's only there's 2 big ways to get money out of an asset. One way is to borrow against it. You go to the bank or credit union to borrow. But when you need it the worst, it's the hardest to get because most banks, credit unions don't loan you money based upon what the asset appraises for. They'll have it appraised. They'll tie it up as security, as collateral, but they loan you money based on your ability to repay. Now, if you're borrowing, it means you need the money for some reason, and a lot of times you don't have the ability to repay, and so they'll say fat chance. And so then you're forced to sell it, and many times you have to sell it in a soft market for less than the value was at one point. And so that's one of the big reasons why I do not pay cash for property. I want liquidity. I don't want to be forced in a situation that if I need money, that I have to borrow against it, try to qualify for a loan, or sell the asset in order to get my money. Does that make sense? Liquidity is number 1. Number 2 is the safety. Now, because many times in recessions or tough times, assets, whether it's real estate, machinery, equipment, or whatever, an automobile, those assets sometimes can go down in value. Real estate can sometimes take a 30 to 40% hit, like commercial real estate did after the COVID-19 pandemic. Well, it's just going to happen. Well, if you have a lot of your money tied up into that, if you were taking all your positive rental cash flow and sending it against the mortgages for years, and then all of a sudden we have 30 to 40% vacancies, and so now you are having a hard time meeting the mortgage payment, even though you've sent all these extra principal payments against the mortgage, you paid it down, you have all this equity, but you don't have the ability to access it because they're not going to loan you the money. The interest rates will probably be higher, but it doesn't protect the safety of the principal. The asset goes down in value. I remember in 2007, my home appraised for $1.5 million in Salt Lake City. 1 year later, in 2008, it only appraised for $1.1 million. It went down in value $400,000. But my money was safe. Why? Because I had an 80% loan to value, a first mortgage, and I borrowed the last 20% with a HELOC. And even though I was borrowing on that home equity line of credit, at 6% interest and at a 33% tax bracket. That was a net cost of 4% because of it's tax-deductible interest. I was borrowing on the last $300,000 of equity at 4% net. But I was making 8% plus. How much more is 8 than 4? Don't say 4, it's double. It's 100% rate of return. On that last $400,000, I might be paying $16,000 a year in interest, but I'm making $32,000, double that. And so that brings me to the third reason why I keep it separated. I want safety so that when my house goes down in value, let's say, if I'm talking about a piece of real estate, I had critics go, neener, Mr. Andrew, you're underwater. You owe more than your house is worth. Did I care? No, I was in control. The banks loved me because I had the money. I had the money. It wasn't locked up in the house. And they worked with me all day long. But I had the ability, because I was earning twice as much as the mortgage, I only had to peel off half of what I was earning to meet the mortgage payment. I was in control. If I had all that money tied up in equity in the property, I would have been in real trouble like a lot of people were in 2008. So I have safety of my money. When the real estate goes down in value, I haven't lost because my money was not tied up in it. The next thing is I'm earning a rate of return. I was earning a rate of return actually more like 10%, but let's just go down to 8. Again, if I'm earning 8% and I'm paying a net of 4%, and by the way, my first mortgage was less than that. I was borrowing money at 4.5%, a net cost of 3%. But my second mortgage was higher. It was a cost of 6% and a 33% bracket, a net cost of 4%. So on 80% of my equity in the property, I'm paying a net of 3 and I'm earning, 8, 9%. I'm making 300% on that. On the last 300,000, I was earning just double. I was paying 4%, but I was making 8% to 9%. And so I was in control. I was making double, and on the first 80% of the equity in my home, I was making nearly triple the rate of return over the cost of the funds. If you do the math, you'll have enough money compounding to totally pay off the home about 2.5 years faster than any form of sending extra principal payments against your mortgage, because you will give up liquidity, safety, and you'll give up earning a rate of return of double or triple the cost of the funds. But what's the fourth reason? I do it for the tax advantages, because on most assets, if it's a business asset or if it's on personal, rental real estate or whatever, I can deduct the interest. And so I do it for tax benefits, which sweetens the rate of return. Because like I said, if I borrowed out of my home at 4.5% interest on a first mortgage, $1,200,000, I'm paying 4.5%, but that's tax deductible in a 33% bracket. It's only a net cost of 3%. I've actually been compounding in my laser funds over 9, but at least netting 9 to 9.6. How much more is 9 than 3? It's 300% more. But I'm able to do that because of the tax advantages, makes the rate of return even better. Even on the last 300,000, the last 20%, paying a 6% interest doesn't cost me 6% because of the tax benefit. It's deductible. And so it's a net cost of 4 and I'm making 8. I'm still making a 200% more. I mean, would you hire an employee for, $40,000 that made you an extra $80,000? And would you buy a widget machine for $30,000 that made you an extra $90,000? These examples are like 200 to 300% rates of return on your employment cost or equipment costs. It's just how money works. So that's why it's important to understand the actual cost of pulling money out of an investment when you're buying an asset, because people say, well, that's not costing me anything. It costs me money if I borrow. No, for me, it's costing me money to use my own money because I give up the opportunity cost, the ability to earn a rate of return, compounding tax-free at double to triple the net cost of borrowing OPM. This is what makes the world go round, and this is what banks and credit unions do. You can utilize this with what I call a laser bank. What's a laser bank? It's where I keep my serious cash, compounding, tax-free, earning rates of return averaging, in that 9 to 10% range. Some years higher, some years lower, but averaging 9, 10%. And if you want to learn how you can do this and maintain liquidity, safety, rate of return, and maintain those tax benefits so that you just don't go out and tie up all your money in these assets, when they go down in value, you will lose. I promise you, you will lose. So study this in my book, The Laser Fund. This retails on Amazon for $20 plus shipping and handling. This has been flying off of our warehouse shelves, and it's because I'll gift you a copy of this 300-page book for free. Now, it's actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations. If you're a left brain learner, if you're a right brain learner, you learn more by stories and examples. You flip it over to this one. This is about 100 pages, 12 chapters with 62 actual client stories. And so you simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. I'll fire out a hard copy to you via priority mail. When you're in there claiming your free copy of the book, check out if you like to listen and learn, watch and learn. There's even regular educational webinars we teach. They're free. And if you even want a consultation with an IUL specialist that I oversee, you can schedule an appointment with no cost or obligation. So don't miss out on understanding this incredible power of compounding your money tax-free and not disturbing that when you can borrow in order to acquire assets and earn 100 to 200, 300% rates of return greater than the net cost of the funds.